Good morning, ladies and gentlemen. My name is Paul Sunderland with Goldco Precious Metals. With me today, I'm delighted to welcome Mr. Jim Rickards, a global financial expert, of course, and I'm absolutely delighted to have you here today because we have an awful lot of very serious things happening in the world, and I know you have an important point of view that I think our clients ought to hear about.
Looking forward to our discussion, Paul.
Splendid. This is a very important time, I believe, in the history of the world. We've had a number of monetary collapses over the last 100 years, plus, some near misses, particularly in 1998 and 2008. Since Goldco specializes in protecting people's retirement savings, how close do you think we are to a new collapse, and how would gold in their IRAs protect our clients?
First of all, Paul, you're exactly right about the periodic collapse of the international monetary system. When I talk about that, it sounds like some impossible or draconian or extreme event, but the fact is it has happened 3 times in the past 100 years. In 1914, just on the brink of World War I, again in the late 30s leading up to World War II, and then in the mid-70s, most prominently in 1971, when President Nixon suspended the redemption of overseas dollars for gold. Now, when this happens, it's not the end of the world. I'm not suggesting we all go live in caves with, ammo and baked beans. Life does go on, but what happens is that the system collapses, and then the global monetary elites, and this is not some deep dark conspiracy. We know who these people are. It's Mario Draghi and Janet Yellen, the Secretary of the Treasury, and finance ministers, and prominent academics. It is a set of people that we know will come together, as they did at Bretton Woods in 1944, as they did in Genoa, Italy in 1922. There was another monetary conference then, and reform the system, reshape the system, and you go forward with a new system. And my point is that, specifically to answer your question, we are getting close to one of these periodic monetary collapses. The last one was, 1971 was a catalyst. It played out over a couple of years between 71 and 73. It's been over 40 years since the last one. If you look at the tempo, 1914, 1939, 1971, they happen every 35 or 40 years. They're not that rare. So I'm not saying it happens like clockwork tomorrow, but no one should be surprised if it does. And that's really the point. So my message to investors, and I think this is what Goldco is saying also, is that, okay, it could be tomorrow, it could be next year. I don't know exactly when it's going to happen, but we're getting close. We're overdue. When it happens, the system will be reformed, and what I'm trying to do is to say, okay, what will that new system look like? What will the role of gold be? And if it has an important role, which I expect it will, now's the time to get some gold, because when this happens, you might not be able to get it, number one. Number two, the price might be so high that you've missed the opportunity. So now is a good time to do that. So looking at what the new system might be. Oh, by the way, there may be mini collapses before the big one. Think of it as an earthquake, so what's a big one? Well, 8 on the Richter scale is off the charts. That is devastating. But you can have a series of, 6s or 7s, which are pretty powerful earthquakes, leading up to that big one. Well, maybe we're all worried about the 8, let's call it, on the Richter scale, the one where, the gold goes up by a factor of 10, which it would not surprise me at all, $10,000 an ounce, et cetera. The value of currencies in real terms collapses. We have something like hyperinflation. So let's call that the 8 on the Richter scale. But there could be many collapses along the way. But the problem with retirees in particular, you don't have time to bounce back. So if you're 30 years old and you've got some savings, and maybe you take a beating, the stock market crashes or whatever, well, that's not a good outcome. I'm not suggesting that, but you do have time to make it back. But if you're 70 or 75, and you get caught in one of these downdrafts, you don't necessarily have time to make it back for your own retirement or for your children. So that's why I recommend gold as part of a portfolio, not all in, not 100% by any means, but 10% of your investable assets in gold will preserve your wealth in these kinds of collapses that I'm talking about. But we can definitely see it coming. I would say the big one will definitely be bigger than or worse than 2008. And why do I say that?
Really?
Because there are metrics. This is not guesswork. I don't have a crystal ball. We actually use scientific models to make these kinds of projections. Nothing was solved in 2008. Nothing. We got through it. We're still standing, but the banks that were too big to fail are bigger. They have a larger percentage of the banking assets. They have larger derivatives books. Everything that was wrong in 2008 is worse today. Now, yes, the government propped it up, I understand
Right.
that, and kept the game going. We had an expansion and so forth. But all that embedded risk is there. It's bigger. It's just a matter of time before it collapses. And there's a relationship between the size of the system and the size of the collapse, and it's exponential. So if you double the system, you don't double the risk. You increase it by a factor of 5 or 10. That's what we're looking at. So I
Right.
do expect this sooner than later. I'm not saying tomorrow. I'm not even saying next year, but sometime in the next several years. There could be smaller collapses along the way. That's highly likely. And for retirees in particular, you don't have time to bounce back. You have to prepare
Right.
today.
Right. I appreciate that. Thank you. You know, given China's apparent insatiable appetite for gold, could this increase their role in the world banking system? And what impact do you foresee it having on future monetary policy?
Well, you're right about China's appetite, Paul. They have acquired, my estimate is 4,000 to 5,000 tons of gold in the last 7 years. Now, no one knows the exact amount because they are non-transparent about it. They officially, they've gradually announced that they've gone from 600 tons to 1,000 tons to 1,600 tons, and they're now doing monthly updates. That's mostly to appease the IMF, the International Monetary Fund.
Indeed.
The International Monetary Fund insists on some transparency, so the Chinese said, okay, we'll be transparent, we'll update monthly, but of course, they're still non-transparent. They actually have two entities that can hold the gold. There's the People's Bank of China, which has their official reserves. And then there's a more mysterious entity called SAFE. That's the State Administration on Foreign Exchange, run by an ex-PIMCO guy. It's Bill Gross's old firm.
Absolutely.
So these are not kind of people walking in off the countryside. These are world-class financial managers. The People's Bank of China reports results, but SAFE is non-transparent. So what they do, they acquire gold through SAFE, and their agents are foreign banks. Hong Kong Shanghai Bank in particular have been out to China and Hong Kong and spoken to the people who actually do these transactions behind the scenes. I've also spoken to secure logistics people. These are the people who handle physical gold. So they drive armored cars, vaults, refineries, not the paper gold world, but the physical gold world. They've told me that they've actually brought gold in from Central Asia with the assistance of the People's Liberation Army using armored vehicles. So believe me, that's off the books. So that gold piles up in SAFE, and then periodically they flip some over to the People's Bank of China and update their estimates. But how do we know what's in the safe, so to speak, or what's in the State Administration of Foreign Exchange? We have some data. We know mining output. It's about 450 tons a year. We'll do that for 5 years. There's over 2,000 tons right there. We'd have data on Hong Kong imports. Hong Kong is transparent. They actually have pretty honest reporting, so we see what's coming in there. We have anecdotal evidence, my friend saying that he's brought it in with the help of the Army off the books. So you can put all this together and estimate that they have, I'll say 5,000 tons. Now just to put that in perspective, there are only about 35,000 tons of official gold in the world. That's, when I say official gold, I'm talking about owned by central banks, sovereign wealth funds, owned by governments, in other words. It's only 35,000 tons. If you bought 5,000 tons out of 35, that's about 15% of all the official gold in the world. That's a huge amount of gold. They've just been doing it very, very persistently. So my question is why? Why are they doing it? What are they getting ready for? What do they see that other people don't see? In the United States, people disparage gold. You're a gold bug, you're a nut, why would you have it, et cetera. And I'm like, wait a second, the Chinese are the savviest, smartest, most long-term thinkers in the world. They're acquiring it by the thousands of tons. What do they see that other people don't see? Well, what they see is what we talked about earlier, which is this possible collapse of the international monetary system. So now the other part of your question is, will this give China a bigger role in the international monetary system? It already has. They've set up, they have a BRICS development bank, that's Brazil, Russia, India, China, South Africa, the emerging markets. They set up something called the Asia Infrastructure and Investment Bank with mostly Asian partners. But what was interesting is the United States was trying to persuade its allies not to join. They all joined. So the UK, France, Germany, they all joined this new bank because this bank is going to let out tens of billions of dollars of infrastructure contracts to build railroads, highways, dams, power grids, et cetera, throughout Central Asia as part of what's called the New Silk Road Initiative. And if you're a German construction company, you want in on those deals, so they joined even though the United States tried to discourage it. So they've set up these multilateral lending institutions. They've got a large amount of official gold, and they're still acquiring it. And of course, as you know, recently the International Monetary Fund, the IMF, included the Chinese yuan in their special drawing rights. Special
Indeed.
drawing rights, a geeky name, the SDRs, but that's world money. It's the easiest way to understand it. People get confused about that, what's an SDR and so forth. It's actually very simple. It's, the Federal Reserve can print dollars, European Central Bank can print euros, the IMF can print money, they can print SDRs, and so I call it world money because that's what it is. There is a set of currencies which are the leading reserve currencies, and those are used, they don't back the SDR, but they're used to calculate the value of an SDR.
Right.
Think of it as a very exclusive club, maybe 18-hole golf course that only has 4 members. Well, they just let in a 5th member, which was China. Very big deal from a prestige point of view. So China's gold hoard is expanding very rapidly. They're catching up to the United States in terms of gold relative to GDP. They're probably actually tied with the United States. It looks like they're trying to move ahead. They're included in the SDR, a very exclusive club. So they already have a prominent role. So the question is, when this financial collapse comes, what role does China play at that point? The answer is they're going to have a very powerful voice. The way I think about it, imagine a poker game and 4 players sit down. Well, if one of them has all the chips and the others don't have any chips, it's not much of a game. So you want everyone to have a pile of chips. So gold are your poker chips when it comes time to reform the international monetary system, and China just built up a very large pile of chips.
Thank you very much. That's understandable. Let me ask you, how likely do you feel is a return to some form of a gold standard, or at least perhaps the use of gold to back world currencies?
The possibility of a new gold standard or the use of gold to back world currencies, it's definitely a possibility. I'm not saying that that's definitely going to happen, and let me explain why. There's not a central bank in the world that wants to go back to a gold standard, not one. Mm-hmm. The question is, do they have to do it anyway to restore confidence? So let's just sort of play out how this goes. So we continue to build up debt, we continue to build up derivatives, we continue to have an unstable banking system, we let greed run rampant, the bankers own Washington, and that's not an opinion. I've spoken to senior Treasury officials, United States Treasury officials behind closed doors, and I said to them, the bankers own this town. And I thought the person I was speaking to would jump out of his seat and be outraged. He looked at me and said, you're right. So believe me, the banks own Washington, D.C. There's no question about that. So as the system spins out of control, then it collapses worse than 2008. So what happens next? That's what I keep thinking about. Where do we go with this? Because you can see the collapse coming.
Right.
Well, the first response function, go all the way back to 1998. What happened in 1998? The Russia long-term capital management crisis. I had a front row seat on that one. I negotiated that bailout. So in that case, Wall Street bailed out a hedge fund. Come forward 10 years, what happened then? The central banks bailed out Wall Street. Come forward another 10 years, 2018. See how each collapse gets bigger? Who's going to bail out the central banks? The Federal Reserve took their balance sheet from $800 billion to over $4 trillion. Guess what? It's still there. They never normalized it back down to $800 billion. So what are they going to do in the next crisis? Go to $8 trillion, $12 trillion? There's some limit. So the next crisis will be bigger than the central banks. So who's bigger than the central banks in terms of bailing out? The IMF. The IMF has the only clean balance sheet left in the world. Our Federal Reserve looks like a really bad hedge fund. They're leveraged about 80 to 1. They could be periodically insolvent on what we call a mark-to-market basis, where you mark all the assets to market. It could take a very small move to wipe out their capital. It varies day to day, but they've been periodically close to insolvency. So there's a limit on what they can do, but the IMF can come in, print these SDRs, and flood trillions of dollars equivalent of SDRs around the world. Now the question is, will that work? It might, only in the sense that nobody understands it. It's sort of like, smoke and mirrors. Because this is among countries. We're not going to be walking around with SDRs in our pockets. This is world money for countries. So they might get away with it in the sense that nobody really understands it and they're unaccountable and unelected. But it will definitely be inflationary. There's no way you can print that much money, hand it out in effect for free. So at a minimum, that would be highly inflationary and the dollar price of gold would skyrocket. That's one outcome. But let's say it doesn't work. Let's say people say, you know what, your dollars didn't work, your euros didn't work, your yen didn't work. Why should we believe in this new money? Why should this new paper money be any more solid? We've lost confidence. We're out of the system. We want gold. That's a very plausible outcome. In that world, the central banks may have to go to a gold standard, not because they want to, but because they have to. And that raises a very interesting question. If you go back to a gold standard, what's the price? Now, this happened before. The world went off the gold standard in 1914 because they wanted to print money to fight World War I. After World War I, you have Versailles Treaty, we're now talking 1919, early 20s, they said, we want to go back to the gold standard. But the question is, what was the price of gold under this new gold standard? And if you've doubled the money supply, in theory, the price of gold should have doubled. That would just be maintaining the relationship. Right. Winston Churchill, who was not a great leader, but not much of an economist, insisted that the UK go back to the gold standard at the old price, at the 1914 price. The problem is, if you have a parity and you double the money supply and you want to go back to the old price, well, you can double the price or cut the money supply in half. He wanted the old price, so they had to cut the money supply in half. Highly deflationary, put the UK into the Great Depression really before the rest of the world. So that was, and he admitted later, that was the greatest blunder of his career, and considering he planned the Gallipoli invasion, that's a major statement.
Indeed.
So the world learned that lesson. Now, if they go back to a gold standard, I'm not saying they absolutely will, I'm just saying that's one outcome, they're not going to repeat that mistake. So what is the implied non-deflationary price of gold under a new gold standard? I've done the math. It's over $10,000 an ounce, possibly much higher, but at least $10,000 an ounce. So this is, when I say that, when I say, you know, gold may go to $10,000 an ounce, which I do expect, I didn't pull the number out of thin air. I'm not trying to get a headline. I'm not trying to be provocative. It's actually 8th grade math. Just look at the gold supply, look at the money supply. You know, you got to make a few assumptions. What's our definition of money? Do the math, and you come up with, at the low end, $10,000 an ounce. Now, at the high end, we're talking $40,000 an ounce. And I'm not predicting that, but this would be where the world has to price gold in a new gold standard to avoid deflation, not repeat the blunder of 1925.
Thank you. You say the Federal Reserve is actually using what is called an equilibrium model in making its decisions, which you believe is the wrong model to understand and assess the true state of the world economy.
Right.
How can physical gold investments help our clients protect themselves from these kinds of errors?
It's a really good question, and maybe we just explain what a model is. So there's the real world, right? We live in the real world, and we make decisions, and things happen, and we watch markets. Well, as an economist or an analyst, you can't run around and ask everybody their opinion every single day. So you build a model of how the world works, but and no model is perfect. Everyone recognizes that, but you try to make them as good as you can, basically. So, but you have to have an understanding of how the world works in order to build the right model. Right. And if you have the wrong model, you're going to get the wrong result every single time. It doesn't matter how smart you are. I've met a lot of the central bank governors and regional reserve bank presidents and prominent economists. They're all smarter than I am. And believe me, these people have 160, 170 IQs. But your IQ points don't help you if you have the wrong model. Now, the Federal Reserve uses what are called equilibrium models, and the idea is, the economy runs like a clock. Just everything's on time, everything's fine, and occasionally it gets out of equilibrium. There's some disturbance that pushes it out. So all you do is you apply policy and get it back into equilibrium, and it's all good. That is not how the world works. The world is a complex, dynamic system. The world can get out of whack, but it could go off in completely unexpected directions. What people call the black swan, and you need to understand that to avoid flying off the handle in the first place. So a good metaphor, and when I say metaphor, yeah, it's a comparison, but it's more than a metaphor. The science is actually the same. So imagine a thermostat in your house, and imagine a nuclear reactor. The Fed thinks they're playing with a thermostat. So if the house is too cool, you dial it up a little bit. If the house is too warm, you dial it down. It's controllable, it's reversible, it's easy to understand. That's an equilibrium model. The world actually works more like a nuclear power plant. Now, you can dial a nuclear power plant up or down. You can you have a neutron generator, put in control rods, pull out control rods. You can dial it up or down, but you better get it right, because if you get it wrong, you'll have a catastrophic meltdown. Absolutely. That's a dynamic, complex system. So my concern is that the Fed's got their hands on the controls. They think they're playing with a thermostat. They're actually playing with a nuclear reactor, and they're going to melt down the whole system. So that's the danger of wrong models. So what can an investor do to prepare for this? Because you can see it coming. And this is why we're talking about gold. Gold will preserve wealth in every state of the world. I don't go all in. I recommend 10% of your investable assets. I should explain what I mean by that. When I say investable assets, don't include your home equity or your business, right? Your home is where you live. Don't gamble with that. Your business is where you make your money, and that's your legacy. Don't gamble with that. Everything else, your savings, in other words, those are your investable assets. Of that, a 10% slice in gold will serve you well. If gold goes down in nominal dollars, you won't get hurt badly because it's only 10%. But if it goes up 2, 3, 5, 10 times, which I expect, that will preserve your wealth, because remember, everything else may be melting down. Your gold will preserve your wealth.
Absolutely.
So that's my recommendation.
Terrific. Thank you, Jim. The premise for Goldco's services is that people need to diversify their retirement savings and convert a percentage, as you've just mentioned, in fact, into precious metals so they can protect themselves against inflation and downturns in the stock markets and the financial markets. Can you describe how that works and why people saving for retirement in particular need the protection of physical gold?
Right. Well, Paul, I'm a big fan of diversification, and I recommend it. And we've spoken earlier about how you don't go all in gold, you don't go all in anything. You have different asset classes, and that diversification serves you well. Now, I don't want to turn this into a lecture on modern financial theory, but the idea basically is that every asset class has a certain fundamental momentum to it. It'll go up or down, but it has certain fundamental dynamics. But in addition, it has a certain amount of noise. When I say noise, these are just random variations that don't really relate to the fundamentals. So the idea of diversification, so I've got, let's say 5 asset classes. I'll just use that as an example. Well, the fundamentals chug along and they prevail, and the noise tends to cancel out, because if the noise is random, if one's going up and the other one's going down, those two things cancel out. So the idea of diversification is to get the fundamental investment thesis, cancel out the noise, and that will give you a higher expected return with less volatility. That's the theory. Here's the problem with theory. A lot of people think they're diversified, but they're not diversified. Their brokers tell them, their wealth managers tell them they're diversified, but they're not really. I run into people all the time. They go, I'm diversified. I own 100 different stocks. And I say, really? You own 100 different stocks? Well, you're not diversified. You have one asset class called stocks. You may have 100 different names in your portfolio,
Right.
but you've got one asset class. You're all in on stocks. And if stocks go down, you lose money. This is not diversification. Then you run into people, they say, well, I've got 60% stocks and 40% bonds. I'm diversified. I say, really? Actually, those are all securities. You're kind of one asset class again, stocks and bonds, because there is some correlation between the two, not perfect, and so on. And so there's a difference between real diversification and what I call faux diversification, which is, on paper it looks like you have a lot of different things, but you don't really, because at certain times they will correlate. Now, you get into a concept called conditional correlation. When we say correlation, we mean, okay, do things move together? That's high correlation, or do they move in opposite directions? That's low correlation or negative correlation. What you want to do when you add asset classes to a portfolio, you want assets that are non-correlated. So that's kind of the holy grail of diversification. But the problem is, how do you calculate correlation? Well, they take all these time series of prices and they do what's called a regression, go back and look at how they did in the past, and then they project that into the future. The problem with that, there's a little gremlin in the system. It's called conditional correlation. Two things may not be correlated most of the time, but they become correlated on certain occasions, namely a financial panic. Best description I've ever heard of a financial panic is, you know what, everybody wants their money back all at once. And people don't understand money. They say, well, I've got a money market fund, I've got a bank deposit, and I've got stocks. And they think it's all money because I can call up my broker and sell it and get the cash in the bank the next day, so I've got money. Really? What if the exchange is closed? What if the power grid's down? What if the sell price is down 30% from the last tick? What if it's happening to all your assets at once, et cetera? What if the SEC shuts the mutual funds? In other words, all these things are good until you really need them, and then they're suddenly not good, and they're all not good together. So that's what we mean by conditional correlation. One of the things about gold, it's first of all physical, so it's not a digital asset. You can close the New York Stock Exchange, or Vladimir Putin can shut it down with his cyber brigades, but that won't affect your physical gold. It really is uncorrelated to these other assets. Sometimes gold and stocks go up together. Sometimes gold goes up and stocks go down. Sometimes gold goes down and stocks go up. But they're really not highly correlated. So in every respect, Gold should be part of every investor's portfolio.
Jim, thank you very much indeed for joining us this morning. It's, I think, been important for our clients to hear your point of view. Thank you again.
Thank you, Paul.
Pleasure. Thank you, ladies and gentlemen, for your time.